I meet hundreds of traders, and honestly, there's one thing that I've noticed about the vast majority of them. 98% of them will never build a real trading edge. Not because they're stupid, not because they lack discipline, because they're trading somebody else's strategy and pretending that it's their own. They're copying setups from YouTube gurus, they're trading patterns that they don't understand, they're using rules built for someone else's psychology and someone else's risk tolerance, someone else's time availability, and then they wonder why they can't last more than 6 months in this kind of market. So in this video today, I want to show you what a real trading edge looks like and why market structure and macro is one of the most powerful combinations that you can build for yourself. So the root problem of this is that most traders are using strategies that are built by somebody else for someone else. You cannot copy their psychology, their emotional tolerance, their wins and losses history, their experience, their timing and execution, their risk thresholds, their patience, their ability to sit in this kind of drawdown and be able to handle it. So even if you copy their model perfectly, you're not copying the part of it that makes it work. You're copying their symptoms. You're not copying their edge. So what does a real trading edge actually look like? A real trading edge is not a pattern. It is not a signal. It's not just a break and retest. It's not just some indicator stack that allows you to take a picture perfect trade every single time. A real edge is a repeatable understanding of how the market behaves under certain conditions, something that you can actually define, something that you can document, and something you can execute consistently. So what are the edge components that pros actually use for long-term profitability? The first one is going to be market structure, the trend, liquidity, break of structure logic, all on the higher time frame. The second is going to be macro direction, what the economy actually supports. Third is the catalyst timing, what triggers events for certain moves. The fourth being volatility regimes, high versus low volatility conditions. Fifth being session behavior, Asia, London, New York. And the obvious ones being your risk model and your execution window, being how much you can lose and survive, and when you're actually allowed to take a trade. This is an edge, not triangles and arrow indicators. So I do want to talk about market structure. Higher time frame market structure is the foundation of an edge because it tells you which way institutions are trading. It tells you where liquidity could possibly be sitting. It tells you very clearly where the possible entry points for a position could be, and it shows you where price wants to go. It shows you exactly where your stop loss should be as well, and where your stops can be. So I've already gone over my gold trade recently, and I've gone over my NASDAQ trades recently. I haven't even taken another swing trade in the month of November because I've just been happy with the profits, and I haven't seen anything that I've liked just yet, besides that one gold loss that I've taken. But for the purpose of this video, we can go over the NASDAQ trade that I took. Again, all of these trades are called out on my socials. I give the analysis, I give the entry, I give the SL, and my TPs completely from start to finish. I do this all live and called out completely free because I just don't believe in ever selling a course. And all this information should be free. You should be understanding the power of market structure plus macro to be able to do this for yourself. First of all, we're going to be looking at the 1 hour. And as you can see, we have lower highs and lower lows being made like this. Not only do we have that, but we have some beautiful zones being tested and mitigated and broken all throughout this price action. Right here, you can see a couple tests of this zone up here. You have this big area of interest down right here that was tested multiple times. And now I'm not saying this is structure that institutions trade, but when you do see a bunch of structure forming like this, you can kind of understand the direction that they would be going in. And you can very clearly see that this is our swing high, this is our swing low. We came back up. We have tested this area repeatedly, and we've actually rejected off of it and moved away from it. We do have this zone right here that was tested once, twice, 3 times, almost 4 times, and on the 4th time, it does break through. So to me, this does signal that the swing high has been respected and we are pushing off of it, meaning that if we did not have market structure break above and form bullish market structure, that we are going to go bullish, this means we are officially bearish and I can look for my bearish move to the downside. And like I said, this was a very clean move for me just because this was such an easy read on the market structure. Not only do we have a clean market structure read, but we did have this area of interest right here that just solidified the entire move for me. And if we scale down to the 15 minute, I think you can see right here, I had marked out the 15-minute opening range of New York. And once we did have a break below this area of interest, I did take this right off the retest. So simple break and retest model right back into a 15-minute key open. And off to the left, you can see we had an Asia low right here, some unmitigated lows to the left as well, and our swing low down here. Now I did TP1 and break even at this Asia low, and I did TP2 right at this unmitigated low. Very, very easy TPs, nothing out of the ordinary. I did want to hold down to this swing low right here, but I did think we were going to have some reactions or a reversal from there. So I was very happy taking very quick trade actually, down to these two TPs, and I should have left runners going, but I was already happy with such quick profits that I didn't really need to. So what are we looking for in a case like this for a perfect market structure plus macro edge? Step one is going to be our market structure. For us, this was bearish. So once we have a good step one, very cleanly done, we move to step two, which is our macro bias. And at the time being, this was the government shutdown era. We were coming out of the super bad reports that had been released and delayed. So obviously the NASDAQ was not going to be looking very good with risk on assets. This would have been good for gold longs or NASDAQ shorts. So the macro now is allowing me to see that we are going to go short. Step three, identify my swing highs and lows. Once doing that, you can see how I identified the swing highs and swing lows. We looked for some rejections off of those, and if we're respecting the swing high, that means we are going to possibly make a new swing low since we are in bearish market structure. Once we've identified the swing highs and swing lows, identify area of interest for entry. We did that right here. We found our area of interest, very clean. Wait for a break below it, and then the break and retest for the entry. And step five is going to be the break and retest model. Nothing crazy going on here. Like I said, the entry model is like 20% of the overall strategy. Everything else has to be rock solid, being your macro bias and your market structure. If those are in line, your entry shouldn't matter as much. You should favor being in the trade and positioning yourself correctly over trying to make a complete sniper of an entry here. So that being said, why does the macro give you the other half of the edge that you need? Macro tells you exactly when volatility will expand, when trends will continue, when reversals actually do make sense, which sectors will benefit from the environment, which assets institutions are rotating into, and which assets are getting smoked. In this case, the NASDAQ was getting trampled on. You saw these massive, massive drops from the highs all the way down, and I was doing nothing but continuing to follow that. As an example, CPI releases move markets seconds after release, typically 0.1 to 0.3 seconds reaction time. Fed speakers can cause instant reversals on the charts, sometimes before the transcript is even posted. During rate hikes, tech and growth stocks underperform, and the dollar strengthens and metals weaken. During rate cuts, risk on assets outperform, equities run harder, and growth stocks explode. 92% of multi-week market trends align with macro regime shifts, and that is from a Swiss study. So I want to go through an example being, say, rate cuts plus tech strength. So when the Fed hints at rate cuts, that fuels tech stocks. Why? Because cheaper money increases future earnings potential. So if the macro environment is supporting tech and the NASDAQ is showing me bullish market structure, that's not a trade, that's an edge. Another example being my best one as well was when the tariff headlines dropped and indices fell instantly. Not because of manipulation, because macro just altered future cash flows. And if you understand macro, you understand these drops aren't random, they're just repricing events. And this is where everything comes together. Market structure tells you, here's the trend, here's the path of least resistance. Macro is telling you, here's why that trend exists and why it's likely to continue. When those two align, you're no longer needing constant scalping, 20 indicators, TikTok strategies, random pattern recognition, guessing where a breakout is going to be or hoping for a retest. You're trading with logic behind the move. That's not randomness inside the move. That is your true edge. You're trading the trend. You understand the catalyst behind it. You understand the volatility window. You know the invalidations and you know the reasoning. There's zero ambiguity. So yes, most traders will never build an edge because they think an edge is a pattern. If you want longevity, if you want to survive more than 6 months in these scary markets, if you want to actually have your trades make sense, build an edge around how the market is truly moving. Market structure is for your direction. Macro is for conviction. Catalysts are for timing. And execution is for precision. This combination doesn't just improve your win rate, it seriously changes the entire way that you see and understand the markets. So this is the real edge that you want, not somebody else's strategy, not some chart pattern from a YouTube guru or a shortcut or a hack. There are no such thing as shortcuts in the markets. If you understand why the market is going to move, where it's going to go, and when it's most likely to get there, you just trade from that place, a clear place of logic, alignment, and clarity. You stop surviving the market and start working with it. This is how you last, this is how you grow, and this is how you become a real profitable trader. If you guys found value in this video, make sure to leave a like, subscribe, leave me a comment of any questions that you have, and we'll see you in the next one.